After studying this module, you would know about transfer pricing, understand the concept of optimal transfer pricing, evaluate testing of prices, know about the concept of dumping, know about the effects of dumping, know the types and objectives of dumping, and finally understand price discrimination under dumping. First of all, let us look at the concept of transfer pricing. Transfer pricing is the setting of a price for a good or service sold between the controlled or related legal entity such as the parent company within an enterprise. For example, if a subsidiary company sells a good to the parent company, the cost of the goods sold to the parent company and the cost of those paid by the parent company to the subsidiary is the transfer price. Legal entities considered under the control of a single corporation include branches and companies that are wholly or majorly owned ultimately by the parent corporation. Certain jurisdictional considerations are there. The entities have to be under a common control if they share family members on their board of directors. Transfer pricing can be used as a profit allocation method to attribute a multinational corporation's net profit or loss before taxes to countries where its business is done. Transfer pricing results in setting of prices among divisions within an enterprise. In principle, the transfer price should match either with what the seller should charge as an independent arm's length customer or what the buyer would pay to an independent arm's length supplier. While unrealistic transfer prices do not affect the overall enterprise directly, they become a concern for the government taxing authorities when transfer pricing is used to lower profits in a division of the enterprise located in the country that levies higher income tax and raises the profits in a country that is something like a tax haven that does not levy any taxes or has got a lower rate of taxation. Therefore, the main motive of transfer pricing is to, on the books of accounts, transfer a profit from a high tax economy, from a high tax country to a low tax country or to a country which is a tax free haven. This is the basic notion and motive for transfer pricing. Now let us consider optimal transfer pricing. The discussion in this section explains an economic theory behind optimal transfer pricing, with optimal being defined as the transfer price that maximizes the overall firm's profits in a non-realistic world with no taxes and no capital risk, no development risk, no externalities or any other frictions which exist in the real world. In practice, a great many factors influence the transfer prices that are used by multinational corporations, include performance measurement, capability of accounting system, import quotas, customs duties, VAT, taxes on the profits, and in many cases simply the lack of attention on the pricing. Now let us consider a diagram. Here on the vertical axis we have cost and price per unit, and on the x-axis we have output per time period. The demand curve is downward sloping. This is the blue line which is downward sloping. It is the demand curve that the firm faces. The marginal cost curve, which is the red line, is upward sloping. It is the firm's marginal cost curve. And then we have a marginal cost of production which is lower, and which is the blue line, which is also upward sloping. The marginal revenue curve on the other hand lies below the demand curve or the AR function, as we know, and the marginal revenue curve of the firm is the black line. Below the marginal revenue curve of the firm, we have the marginal revenue curve of production, of the production unit. That is in red, and it is also downward sloping, but lies well below the marginal revenue curve. Now let us consider the pricing situation. At point C, the marginal cost curve is intersecting the marginal revenue curve of production. So therefore the marginal cost curve of production, which is in blue, is intersecting the marginal revenue curve of production, which is in red, and this gives us point C, at which the price should be point PT. On the other hand, the marginal cost curve of the firm, which is upward sloping, it is a red line, it intersects the marginal revenue curve of the firm at point A. But at this point, the price on the firm's demand curve is determined at point B, and at this point the price is P star. Now let us consider what is happening in this situation. This we could call the economics of transfer pricing. From the marginal price determination theory, the optimum level of output is that where the marginal cost equals marginal revenue. That is to say, the firm should expand its output so long as the marginal revenue from additional sales is greater than the marginal cost. In this diagram, it follows that the intersection is represented by point A, which will yield a price of P star with a given demand at point B. When a firm is selling some of its product to itself, and this is an intra-firm transaction, then only to itself, then there is no external market for that particular good which has been transferred from the subsidiary maybe to the parent company. When the picture gets more complicated but the outcome remains the same, the demand curve remains the same, the optimum price of the quantity remains the same, but the marginal cost of production can be separated from the firm's total marginal cost. Likewise, the marginal revenue associated with the production division can be separated from the marginal revenue of the total firm. This is referred to the net marginal revenue in production, NMR, and is calculated as the marginal revenue from the firm minus the marginal cost of distribution. Now, considering this, it can be shown algebraically that the intersection of the firm's marginal cost curve and the marginal revenue curve at point A must occur at the same quantity as the intersection of the production division's marginal cost with the net marginal revenue from production at point C. So, given this fact, we can understand how pricing takes place under conditions of transfer pricing. Now let us consider another diagram. In this diagram, on the vertical axis we have cost and unit price. On the x-axis we have output per unit period. Here we see that the blue line, which is the demands curve of the firm, and the marginal cost curve of production is the red line, which is upward sloping. The demand curve is obviously downward sloping, and then we have the marginal revenue of the firm, which is again downward sloping and is represented as a black line, which is downward sloping. And then we have different points A, B and C along the marginal cost curve. The original demand curve, if we were to have a competitive situation, would be demand 1, which is relevant for transfer pricing because it is an inter-firm transaction, and then we could have another line which is demand curve 2, which is also for transfer pricing. Now let us consider this diagram. Transfer pricing with an competitive external market. So far we were not considering the competitive external market. The competitive external market gives us the demand curves which are parallel to the x-axis, that is, it is represented by the higher blue line, which is CD, and the lower blue line, which is BE. Now let us consider what is happening. If the production division is able to sell the transferred good in a competitive market as well as internally, then both must operate where the marginal cost equals marginal revenue for profit to be maximized. Because the external market is competitive, the firm has a price is a price taker and must accept the transfer price determined by the market forces. Their marginal revenue from transfer and their demand for transferred product becomes the transfer price itself. If the market price is relatively high, that is at PTR 1 in the figure 2, then the firm will experience an internal surplus or an external excess internal surplus equal to the amount QT1 minus QT2. The actual marginal cost is defined by points A, C and D. Now let us consider how price discrimination takes place under the arrangement of transfer pricing. We have three diagrams, three parts of this diagram: the final good, the external demand for the transferred good, and the aggregate demand curve, which is representative of combining or merging these two demand curves. Both the demand curves, as for the final good or for the external demand for the transferred good, have a demand curve which is downward sloping, as you can see, and then below that we have the marginal revenue, both of which are in red and are downward sloping. Only the nature of the slope between these two curves is different. On the right hand side we have a steeper demand curve, and on the left hand side we have a flatter demand curve, and correspondingly the marginal revenue curves are also accordingly either steeper on the right and flatter on the left. Now if we were to make a joint marginal revenue curve and a marginal cost curve, which is represented by MC1, such that in the final analysis the equilibrium takes place where the marginal cost curve intersects the aggregate marginal revenue curve, then we have a price PT which is prevalent across both markets. the transfer pricing with an imperfect external market. If the firm is able to sell the transferred good in an imperfect market, then it need not be a price taker. There are two markets, each of which have its own price, that is P of F and PT. These are the two prices which are represented in the diagram. So, each of these markets has its own price, P of F and PT. The aggregate market is constructed from these two, that is, at point C there is a horizontal summation of A and B, and likewise for all other points. The net marginal revenue curve, NMRA, the net marginal revenue curve, is represented in the third diagram, and here we can see that the total optimum quantity Q is the sum of the two quantities in both the markets. So, this is how we can understand the concept of optimal transfer pricing. Now, let us look at testing of prices. Tax authorities generally examine prices actually charged between related parties to determine whether the adjustments are proper or not. Such examination is by comparison of such prices to comparable prices charged amongst unrelated parties. Such testing may occur only on examination of tax returns by the tax authorities, or taxpayers may be required to conduct such testing themselves in advance or filing tax returns. Such testing requires a determination of how the testing must be conducted, referred to as the transfer pricing methods. First of all, let us consider the best method rule. Some systems give preference to a specific method of testing prices. OECD and the US system, however, provide that the method used to test the appropriateness of the related party price should be that method that produces the most reliable measure of arm's length results. This is often known as the best method rule. Under the system, it may be required that more than one testing method be considered. Factors to be considered include comparability of the tested and the independent items, reliability of available data, and assumptions under the different methods, as well as the validation of the results of the method by another method. Comparable uncontrolled price, CUP. Most systems consider a third party price for identical goods, services, or property under identical conditions, called as the comparable uncontrolled price, CUP. To the most reliable, it is meant to be the most reliable indicator of an arm's length price. All systems permit testing using this method, but it is not always applicable. Further, it may be possible to reliably adjust CUP when the goods, services, or property are identical, but the sales terms or other limited items are different. As an example, an interest adjustment could be applied where the only difference in the sales transaction is the time for payment. That is, it could be 30 days versus 60 days. CUPs are based on actual transactions. For commodities, actual transactions of other parties may be reported in a reliable manner. For other items, in-house comparables, that is, transactions of one of the controlled parties with the third party may be the only available reliable data. Other transactional methods. Among other methods, relying on actual transactions generally between one tested party and a third party and not the indices or aggregates of market surveys are done, and these methods include cost plus method, C plus method. Goods or services provided to the unrelated parties are consistently priced at the actual cost plus a fixed markup. Testing is by comparison of the markup percentages. Resale price method, RPM. Goods are regularly offered by a seller or are purchased by a retailer to and from unrelated parties at the standard list price at a fixed discount. Testing is by comparison of the discount percentages, and then we have the gross margin method. Similar to resale price method recognized in a few systems, we also use the gross margin method. Then we have profitability method. Some methods of testing prices do not rely on actual transactions. Use of these methods may be necessary due to the lack of reliable data for transactional methods. In some cases, non-transactional methods may be more reliable than the transactional methods because the market and economic adjustments to transactions may not be reliable. These methods may include CPM, which is comparable profits method, where the profit levels of similarly situated companies in similar industries may be compared to an appropriate tested party. Transactional net margin method, TNMM. While called a transactional method, the testing is based on profitability of similar businesses. For this, let us examine the OECD guidelines given below. Profit split method. Total enterprise profits are split into a formulary manner based on an econometric exercise. CPM and TNMM have practical advantages in the ease of implementation. Both methods rely on microeconomic analysis of data rather than specific transactions. These methods are discussed further with respect to the US and the OECD systems. Two methods are often provided for splitting profits: comparable profit split and residual profit split. The former requires the profit split to be derived from combined operating profit of uncontrolled taxpayers whose transactions and activities are comparable to the transaction activities being tested. The residual profit split method requires a two-step procedure. First, profits are allocated to the routine operations, then the residual profit is allocated on the basis of non-routine contributions of the parties. Residual allocation may be based on the external market benchmarks or estimation based on capitalized costs. Tested party and profit level indicator. While testing of prices occurs on other than purely transactional basis such as CPM or TNMM, it may be necessary to determine which of these two related parties should be. Testing is to be done of that party, testing of which will produce the most reliable result. Generally, this means that the tested party is that party which is most easily compared in terms of functions and risks. Comparing the tested party's results to those of the comparable parties may require adjustments to results of the tested party or the comparables for such items as the level of inventory or receivables. Testing requires determination of what indication of profitability should be used. This may be net profit on the transaction, return on assets employed, or some other measure. Reliability is generally improved for TNMM and CPM by using a range of results and multiple year data. This is based on circumstances of the relevant countries. Dumping. Now, let us take on the concept of dumping. In economics, dumping is a kind of a predatory pricing practice, especially in the context of international trade. It occurs when manufacturers export a product to another country at a price either below the price charged in its home market or below its cost of production. Obviously, this is not a good practice. The positive effects of dumping are consumers of the country in which the product is being imported and is being dumped benefit from the lower prices, and there would be a saving or a consumer surplus. Dumping can force industries or companies in foreign markets that are importing markets to become more competitive and innovative. If they believe the dumping may continue for a long term, then they have no choice but to look for ways and means of reduction in the cost of production, improvement in quality, and so on, to differentiate their own products which otherwise would be selling for a higher price. Either way, this benefits the consumer. Dumping allows the exporting countries and the companies to sell backlog of inventories and the products that may otherwise go waste. This can result in a better revenue in terms of numbers, which would lead to more jobs or to higher pay for the employees and ultimately to a better standard of living for the exporting country. For example, if a cell phone manufacturer has 5 lakh extra phones in inventory and they couldn't sell it in USA, they could at least be better off by selling it in some other country where it can be sold more cheaply. Holding on to them would only lead to obsolete technologies and worthless phones. The money received from foreign countries would be better than none at all. Negative effects. the negative effect of dumping is felt on the host country, that is the recipient of the cheaper good through import. The lower import price leads to more of import, and very often imports may not be essential. If the elasticity of import is high, then the volume of import would also increase more than proportionately. Thus, the lower price will lead to a very voluminous jump in the import bill. Import acts as a leakage. Thus, the national income of the host country would also go down. This would depend on the nature of the import function. Here, the propensity to import would matter. If the propensity to import is high, then the loss in terms of GDP or national income would be large. There would be unemployment in the importing country because the host country would not be producing that particular commodity in abundance because it is being dumped. Now, what are the types of dumping? There are three types of dumping: sporadic or intermittent dumping. It is adopted under exceptional or unforeseen circumstances when the domestic production of a commodity is more than the target that should be there and remains unsold in terms of a stock even after the domestic sales. In such a situation, the producers sell the unsold stocks at lower prices in foreign markets without reducing the domestic price. This is possible only if the foreign demand for this commodity is elastic and the producer is a monopolist in the domestic market. His aim may be to identify this commodity in a new market or to establish himself in a foreign market to drive out the competition amongst the producers in the foreign market. In this type of dumping, the producer sells his commodity in a foreign country at a lower price which covers his variable cost and some current fixed cost in order to reduce the losses or minimize the losses. Persistent dumping: when a monopolist continuously sells a portion of the commodity at a higher price in the domestic market and the remaining output at a lower price in the foreign market, it is called persistent dumping. This is possible if only the domestic demand for that commodity is less elastic and the foreign demand is highly elastic. When costs fall continuously along with an increase in production, the producer does not lower the price of the product more in the domestic market because the home market is less elastic, demand in the home market. However, it keeps a low price in the foreign market because the demand is highly elastic in that market. Thus, he earns more by profit selling in the way of profit by selling more of the quantity in the foreign market and less of it in the domestic market. As a result, the domestic consumer could also benefit from this price because they are required to pay less than what would have been the case in the absence of dumping. So, this is some kind of tactical pricing. Predatory dumping. Predatory dumping is one in which the monopolist firm sells a commodity at its very low price or at a loss in a foreign market in order to drive out some competitors. But when the competition ends, it raises the price of the commodity in the foreign market. Thus, the firm covers the loss if the demand in the foreign market is less elastic, and hence its profits may be more. What are the objectives of dumping? The main objectives of dumping are the following. To find a place in the foreign market, a monopolist resorts to dumping in order to find a place or to continue to himself in the foreign market, his presence in the foreign market. Due to perfect competition in the foreign market, he lowers the price of his commodity in comparison to other competitors, so that the demand for this commonly increases. For this, he often sells his commodity by incurring a loss in the foreign market to sell surplus of the commodity. When there is an excess of production of a monopolist's commodity, he is not able to sell in the domestic market, but he wants the surplus to be sold at a very low price in the foreign market. But this happens rather occasionally. Expansion of industry. A monopolist also resorts to dumping for expanding his industry. When he expands, he receives both internal and external economies, which lead to the application of the law of increasing returns. Consequently, the cost of production of his commodity is reduced, and by selling more of the quantity of the commodity at a lower price in a foreign firm, he may earn larger profits. New trade relations. The monopolist practices dumping in order to develop new trade relations abroad. For this, he sells his commodity at a lower price in a foreign market, thereby establishing new market relations with those countries. As a result, the monopolist increases the production, lowers the cost, and earns more profits. Price determination under dumping. Under dumping, the price is determined just like under discriminating monopoly. The only difference between the two is that under discriminating monopoly, both markets are domestic, while under dumping, one market is domestic and the other market is foreign. In dumping, a monopolist sells his commodity at a high price in the domestic market and at a low price in the foreign market. What are the conditions? Price determination under dumping is based on the following conditions or assumptions. The main assumption of the monopolist is to maximize profits. The objective is to maximize profits. He therefore produces that output at which his marginal revenue equals marginal cost. Since he sells the commodity in the domestic market and the foreign market separately, he adjusts quantities in such a manner that each market has the marginal cost being equal to the marginal revenue. So, given the marginal cost of producing the commodity, the most profitable monopoly output will be determined at a point where the combined marginal revenue of both the markets equal the marginal cost. In other words, the dumping profits would occur when the marginal revenue of the home marginal revenue and the foreign marginal revenue both put together should be equal to the marginal cost. The elasticity of demand must be different in two markets. Only then it is possible to have different prices in two different markets. The demand should be less elastic in the domestic market and perfectly elastic in the foreign market. As a result, the monopolist sells the commodity at the lower or the competitive price in the foreign market and at a higher price or the monopoly price in the domestic market. Thus, the price and the marginal revenue are related to each other by this equation. As is known, marginal revenue, which is equal to price, or AR, is equal to 1 upon 1 minus E, where E refers to the elasticity of demand. The foreign market should be perfectly competitive and the domestic market is a monopoly market. The buyers in the domestic market cannot buy the cheap commodity from the foreign market and bring it into the domestic market. That means that the product is not transferable back from the foreign market to the domestic market. Now this is the explanation. Given these conditions, price and output under dumping will be determined by the equality of the total marginal revenue and the marginal cost of producing the commodity in both the markets. In the figure illustrated below, the price output determination is given for the case of dumping. You could notice over here that on the vertical axis we are giving price and cost. On the horizontal axis we have output. There are two red lines which are downward sloping. The outer line is domestic demand DH, and the inner downward sloping red line is the marginal revenue in the market. And the demand curve DF, which gives us the price of OP, is the competitive price, because here the average revenue, which is equal to the marginal revenue on DF, which is a horizontal demand curve, should be equal to the marginal revenue, which is downward sloping, and this occurs at the point R. And on the other hand, the marginal cost would be equal to the competitive price at point E, and here the output would be T. Therefore, what we can see is that the foreign market demand curve faced by monopolist is the horizontal line, which is PDF, which is also the marginal revenue curve, because in the foreign market it is assumed to be the competitive price and it is perfectly elastic. The demand curve in the home market is less elastic and it is downward sloping, and this is the curve DH, and its corresponding marginal revenue curve is MRH. The lateral summation of MRH and PDF curves leads to the formation of TREDF as the combined marginal revenue curve. As you can see, this is the combined marginal revenue curve. And now what we see is that in order to determine the quantity of the commodity produced by the monopolist, we take the marginal cost curve as MC. E is the equilibrium point where MC curve equals the combined marginal revenue curve, and then we draw the curve TREDF. Thus, the OF output will be produced for sale in the two markets, since FE is the marginal cost. Equilibrium in the domestic market will be established at point R, where marginal cost FE equals to the marginal revenue in the home country, where FE is equal to HR. Now OH is the quantity which will be sold at HM price in the home market, and the remaining quantity HF will be sold in the foreign market at OP, which is equal to FE. Thus, the monopolist sells more in the foreign market with a more elastic demand and a lower price in the less than the home market. So this is how the monopolist exploits the situation which has got different markets and different elasticities. The total profit is TREC. Now let us summarize what we have said so far. Transfer pricing is the setting of a price for a goods or service sold between the controlled or related legal entities within an enterprise. Transfer pricing that maximizes overall firm's profit in a non-realistic world with no taxes, no capital risk, no development risk, no externalities or any other frictions which exist in the real world. Tax authorities generally examine prices actually charged between related parties to determine whether adjustments are appropriate. Under dumping, the price is determined just like under discriminating monopoly. The only difference between the two is that under discriminating monopoly, both markets are domestic, while under dumping, one is domestic and the other is a foreign market.